Welcome to Top M&A Entrepreneurs. Today, my guest is William Fry. William is CEO of Mainshares, which is a company and a solution to help SMB buyers close the gap with equity funding to close the acquisition. And William is here to talk about that. He's also the CEO of Beacon Business Brokerage, too. So welcome to the show.
Thanks for having me, John. Excited to chat.
All right. So, William, you got to tell me exactly what this is. And here, I know what the problem is because I help students buy businesses, and they'll come to me and they say, great, it's a $2 million business. SBA is only going to fund me 80%, so I need 20% here. I got 10% from seller financing or 15%, but I need $200,000 to $300,000 I don't have. How do I close the gap? You're going to show me how that's done with Mainshares.
Yep. Yeah, that's exactly what we do. So we have a network of a bunch of different accredited investors who are really interested in owning a piece of SMBs, not looking to operate full time, and they're the perfect kind of partner for these searchers who find great businesses, get them under contract, but need an additional equity infusion to kind of get over the finish line. And that's what we do. So we'll help people kind of set up their capital raise in terms of how they structure the deal, what the standard governance packages are, so the rights of the investors and the rights of the searcher, and then run the capital raise. And then as part of that, we're also helping them with some of the things that need to get done to close actual deals. So there's kind of a lot of moving parts when you're in the final 30, 45 days of an acquisition, especially when the SBA is involved. So we like to get involved there and help out how we can.
So if I brought a good deal to you, and let's say this is day one, it's and the SBA was going to finance it, I need $200,000 to $300,000. So let's say I'm a coach, and the buyer is he's a one and done. He's probably not going to do it again. He's just doing this. I need to raise $200,000. So what's the first thing they do? They go to Mainshares, they fill it out, and you're going to start asking for financial information?
Yeah, that's exactly it. Yeah, so we'll work with them to dial in a model of their acquisition. So the classic sources and uses, how they want to structure their investment offering. And so there's kind of 2 or 3 schools of thought on how you can approach it. We're not out here pushing you into one bucket or another. It really gets down to what does the structure of the transaction look like, how much money you're trying to raise, and then kind of what you alluded to before is what is your game plan as a searcher? Are you looking to buy and operate this business for the next 20 years? Is this a trade that you've spent the past decade in? Are you looking to grow it and then sell it in 5 to 7 years to a strategic or a PE shop, or something in between? And so I think that the right approach in terms of the equity structure really depends a lot on both the business you're buying, but then also what you're looking for as a searcher.
So if I came in and said I wanted to buy a CPA firm, and CPA are typically very profitable if they're doing $2 million top line, $1 million bottom line, I would suggest they do a revenue share agreement because they'd get a cash on cash return very fast.
Sure.
You're leaving that open, but just giving me access to those investors that could put that $200,000.
Right to the investors, and then we also we've done a lot of work to try to standardize these transactions as much as we can. Like if you chat with investors, a lot of their fear is, hey, look, every single investment is different in terms of the rights of the investors. I don't know how much I'm going to get in terms of split of the cash flow of the business. I don't know what due diligence the operator has done. And that's really where we come in. We have standardized investment docs that you can use. And obviously you can redline them with your own counsel, so we're not shoving them down your throat, but we're giving you kind of a jumping off point of docs to use for the transaction. We'll help you set up all of the different compliance pieces you need to do in order to execute well. So whether that's, blue sky filings in the state that you're raising capital, or Reg D filings once the transaction is closed. And then we're going to give you some tools and access to investors to really manage your capital raise. And that can mean, different things for different people. Some people may want transactional capital. So they're looking for people who are going to come in for a $100K check and just be along for the ride. They don't want to have any involvement in the business. Other people are looking for someone who can add more strategic value. Maybe they're looking for 1 or 2 investors who have deep experience in that industry. Maybe they own a business in that industry themselves. And really, we're kind of giving them the tools to manage that capital raise, meet those investors, and close the deal.
Yeah. And is that somewhere I declare, hey, I'm looking for smart money and I'm looking for just hands-off money?
So
How do we know that?
you don't declare it outright, but when investors request access to your capital raise, you'll be able to see a profile on them on what they're looking for and what their ideal involvement in an investment is. And from there, you can kind of weed apart, okay, what is my ideal cap table? What are the investors that I want to work with? And really give that control to the entrepreneur. Because I think like one misconception of our platform is you come on and you have to only work with our investors and we're going to pick the investors and you kind of just take the money and run. It's much more of a platform that enables the entrepreneur to execute on their capital raise. So even if you already have investors, you can invite them to your round. And then obviously you'll be able to meet additional investors on the Mainshares platform.
All right, so you don't have to be exclusive on this. I could be working on the side and raising capital and accepting monies from other investors. It doesn't have to go through there. It's just
Yeah, exactly. And so
parallel.
the kind of pricing options that we have for entrepreneurs is on the one end, we have kind of a flat fee to streamline your capital raise through the Mainshares platform. Additionally, if you want a more hands-on partner to help you go through due diligence, structure the term sheets, get more in the weeds of your capital raise, we have an affiliated broker dealer, and that entity does charge a percentage of capital raised and operates in a more exclusive agreement of, hey, look, if they're involved, they want to be meeting the investors so that they can really do their diligence and satisfy their compliance obligations. But the kind of happy path is if you're looking to just raise 100, 200, 300K, you can sign up on the platform and get started right away.
So I started on the platform. What does it cost to the entrepreneur that starts off on Mainshares?
Yeah, so we have 2 offerings on the capital raise side. We have one basic offering that's $2,500. We're going to give you the tools to manage investor accreditation. You'll bring your own docs. You'll bring your own investors. We'll help set up the SPV. On the second end, we have what we call our standard offering, and that's for entrepreneurs who don't have all of their cap table identified. They don't know all the investors they're going to work with, and they probably don't have investment docs. And so there you kind of get a capital raise in a box. We'll provide you with a form agreement. So that's a term sheet, equity commitment letter, your subscription agreement, your operating agreement. We'll provide access to the Mainshares investor network. And so you can really grow your top of funnel in terms of people you're speaking with. And that price is an $8,000 flat fee.
All right. This sounds more like an angel list than a start engine. Is that right?
Yeah, that's exactly right.
Yeah. And what if they come to you and it looks like they're overvaluing it? No, first, maybe rewind a little bit. Do they already need a commitment from SBA to do this, or can you do it afterwards?
You can do it afterwards or before. Our preference is get the business under contract and have an SBA term sheet. We don't want you wasting time or money. We also don't want to, go through the work of, setting up a capital raise and then the deal doesn't even pan out at all. And we'll work with entrepreneurs. So we're typically digging in, 6, 9, 12 months before they have a business under contract, because that's kind of the average search duration for your self-funded searcher. And through that process, we're looking at deals with you. We're helping you understand, okay, this one has a bit more customer concentration. The SBA is probably not going to lend their typical 80, 90%. They're going to lend closer to 60, 70%. You're going to have to bridge that gap with either equity, or you're going to have to go to the seller and figure out an equity roll or forgivable seller note. And so we do like to get in early. That ensures better outcomes for the entrepreneurs and the investors if it does get to a capital raise, and it gives us a better chance of making sure that good deals are coming to the platform.
Yeah. So if they already have SBA, there's probably a reasonable multiple, because they're just not going to overpay for this. They're just not going to give you a loan. So
exactly.
What other advice do you give to them about how to structure an equity raise from a guy? Like, for example, if a guy's just doesn't have a college degree, just went through the trades, but he's an HVAC guy that's bought and sold his business. He's a millionaire, but he's not very savvy on equity terms.
Sure.
Yeah.
I would say a few things. So I would say one, start early is our advice. Start to build your relationships with prospective investors before you have a deal under contract. That's the best chance of having the shortest capital raise that hits all of your criteria and your objectives, because you're able to allow them to invest in lines and not dots. So if you just bring them a deal under contract, you're not super savvy with the terms, you're raising and you're meeting for them for the first time, there's a higher barrier that you have to clear in the eyes of the investors, because they haven't had the chance to get to know you, to understand how you think, to show that you're diligent, you've looked at deals, you've passed on deals, this is a deal that you really think is great, and that's why you're bringing it to the table. So I'd say, like, number one is meet investors early, start to build your kind of network, and maybe have an email distribution list, keep them updated on your search. And these are things that we'll actively encourage on the Mainshares platform. Is we're not trying to hold the investors behind, a locked door and only allow them out after you pay us. We're trying to be a platform here, so we'll more than happy connect people when they're looking to kind of build out their Rolodex, if you will. The second thing that I would say is don't over-engineer the deal. The best chance of getting a deal done is to follow, 2 or 3 different approaches to structuring that the investors are already familiar with. Then you're not having to educate them on a new investment structure that they haven't seen before. And we see a few different kind of templates, if you will. So one very common one, if there's SBA involved, is a preferred participating approach, which has like the step up, which allows the investors to have, a slight sweetener after there's been a return of capital. If you're looking at a deal that has, a seller note, no SBA loan, or it's a majority equity, typically what we'll see is you'll have cash flow splits that get more and more entrepreneur friendly as you get more money back to the investors. And then I would say the third thing is, like, have a narrative in mind of how do you exit this business for the investors? And there are a few ways to do that. You can achieve it through buying out the investors at like the year 5, year 7 mark. You can achieve it through having a sale to, another strategic, a competitor, or a private equity fund. But you do want to have some amount of narrative prepared so that you're walking through the investors a story that makes sense, that's realistic, and they can really buy into that, and they can buy into the journey that they're going to go on with you. So those are kind of like the highlights, if I will.
Yeah, let me ask you a question, because I've been through the VC model a long time ago, and we took venture capital money. There was a pretty big step up because they thought in every VC portfolio, they think 1 or 2 is just going to be a unicorn, and the rest are kind of dogs, and they get rid of. But these dogs, sometimes they're making a lot of money, or just barely making any money. And then when that term comes up, where the VC has a call option to say, hey, I want my shares back, you got to buy me back at fair market value, that's a lot of money. And then if you took those models to and put it on top of an HVAC company that's only growing 5% a year, how does that work? I'm kind of need some explanation on that.
Yeah, that's very fair. So I would say that there's kind of 2 things at play here. One is setting up the investment structure to protect the company and protect the entrepreneur. And so, there are a few ways that we do that through kind of like standardized rights and governance packages of like, when do you need the approval of investors to do something, when do you not? And then additionally, making sure that there's a minimum cash reserve in the business. You don't want a scenario where either the entrepreneur is being their own worst enemy and making distributions when there's not enough cash in the bank, or when the investors are being needy, maybe they have something in their personal lives that has nothing to do with the business and is pounding the table asking for distributions. And so, like, you want to put in those kind of like sandbox parameters from day one so that everyone's on the same page with the same expectations. I would say the second thing is understanding, who has a call option, who has a put option. For us, typically what we see is the entrepreneur has a call option at year 5. That means the entrepreneur has the right but not the obligation to start buying out investors after a certain amount of time has passed. Rarely will we see a scenario where investors have a put option and they're the only ones with an option. Typically, if that's the case, it's kind of unilateral. But that's where, it gets back to what I was saying earlier, is like, you really want to align up front on, what is your goal with this acquisition? How do you want to use the cash in the business? Do you want to be reinvesting and growing aggressively? Or is it more of a cash flow play where you're going to make distributions to yourself and the investors? And it gets down to, what are your personal financial goals as a searcher? What can the business support? Is this a business that can grow really aggressively? Or is this more of a cash flow play? So like a classic example is an auto shop. With an auto shop, you're not going to magically have more bays appear out of nowhere. You're not going to be able to grow that 20% year over year. Sure, you can probably optimize it. Maybe you can increase pricing so that you have better gross profit. But that's more of a business where it makes sense to have a cash flow distribution, where every quarter, every year, you're distributing to yourself and your investors. And then at some point, you buy them out when they want liquidity. It doesn't make sense to be a business where you're saying, hey, look, I'm going to reinvest aggressively and sell it in 5 years. It just doesn't make sense. It's not practical.
Yeah, it's not scalable.
So I think totally. So there's some considerations that get it on a deal by deal basis where it's hard for us to say, generics, but that's one thing that we love to do with entrepreneurs.
So you've kind of that future story, you say, hey, look, you got to be prepared for this because at some point the investor is going to want the money and we got to figure out how to get their money back.
Exactly. Yeah. And you have to do it eyes
with
wide
the
open.
economics of the business.
100%. So a common thing is nowadays you have seller notes that have a balloon payment. That balloon payment typically can't be paid in the same year of the cash flow of the business. So it's going to cut into the cash reserves, which means there may not be distributions to the investors, or you're going to refinance it into an SBA loan as well. And you want to get ahead of that. You want to make that clear in the model that you show to investors of, hey, I know this balloon is coming due and this is how I plan to handle it, because investors are looking for people who are going to be good stewards of the business. You don't need to be a financial engineer or financial wizard, but you do need to kind of think through, okay, what's going to happen in year 2, 3, 4, 5.
So a lot of these companies are not going to sell unless there's a proof of funds on this business that I can actually buy the business. So you have a solution for that.
Yeah, that's exactly right. So we'll write pre-qualification letters for entrepreneurs as well as for deals that they're looking at. And that's really trying to show credibility and confidence that the entrepreneur can transact, even if they don't have all the cash on hand when they're chatting with the broker. Because a big thing that we've seen over the past 2 or 3 years is buying a business is kind of going through a meme moment. You have a ton of institutional players coming down market. You see lower middle market funds buying platform acquisitions that are worth $2 million, whereas before they'd only buy platform acquisitions that are maybe $5 or $10 million. So they're competing against the individual buyer more than ever. You also have a lot more high net worth family office types that are joining the game as well. And so if you're going after your stereotypical kind of $1 million EBITDA cash flow business, you're getting compared to all of these buyers who have all the funds ready. Sure, they may not be the dream buyer from the owner, but they don't have any question on whether that party can transact or not. Whereas they do for an individual. The other thing that people forget is when you issue an LOI or you issue an indication of interest, everyone looks the same on the piece of paper. They don't know that you're different from the other individuals, that you're not a tire kicker, that you've spent 6 months searching, that you've really understand what it takes to pull off a transaction. You look like every other individual buyer. And what's clear is you're not a PE shop, you're not a fund, you're not a family office. And so what we're trying to do is, okay, let's work with entrepreneurs who are serious, who we believe in. We can write pre-qualification letters to really back them up and show that, hey, there's been a third party that's looked at this entrepreneur, similar to how the SBA lenders will write letters of support, and feels confident that if given the opportunity, there could be an equity raise done for that entrepreneur.
And that's before the SBA gives you a term sheet. You just that
Exactly.
You show some kind of confidence in the ability to raise capital.
Yep. That's
Okay.
exactly it. And help you kind of stand out as you've thought through what it takes to pull off this transaction compared to potential, other individual buyers.
So it looks like you can enter a couple different ways. One, you just even before you have a deal on an LOI, you could start with the platform and
Yep.
You're looking at a company and you say, hey, they're not going to show me the financial report cards unless I send them a proof of funds. You'll do that.
Sure.
And then if I've already got a deal and I've got a term sheet with SBA will do it, I enter the program because I got to make up the gap. Now, tell me about the timeline there, because usually if I have a term sheet already, time is already ticked off the clock of the 90-day letter.
Yeah, that's exactly right. So typically, by the time that we get involved on the Mainshares platform, it's probably around like 60 to 70 days before closing. If you want to work with our affiliated broker-dealer, our recommendation is to get involved with the broker-dealer as soon as you go under contract, because the broker-dealer has a lot more compliance obligations to, FINRA and the SEC, and so the due diligence process is a lot more intense because there's a broker-dealer involved in the transaction. So, if you're just using the self-serve platform where you're going to run the capital raise yourself using our tools, yeah, you typically get involved, 60, 70 days before the deal is set to close. And then during that time, you need to put together your offering documents, put together your investing deck, make sure that you take the data room that you've gathered while you're doing due diligence on the business and get it ready to be presented to investors. And then you want to start inviting investors in and really start to get some momentum behind the capital raise. fundraising, regardless of what business or regardless of who your investors are, it's all a momentum game. And you really want to make sure you have your ducks in a row so you can get investors far enough along on kind of the underwriting or confidence spectrum so that you can get them to, ultimately commit to investing in you. And then once you have a few, you can use that momentum to kind of close out the rest of the round. What the fail mode looks like for entrepreneurs, and we hear about this for people who are like going off platform, or maybe they're just using an attorney to help them with the capital raise, is they don't have everything buttoned up from day one. So they meet an investor, then they need to go find their NDA, they send it to DocuSign, they don't have the data room ready, so they're just sending over the files that they got from the business broker via email. And it's hard as the investor to quickly get to yes or no. And the thing you have to keep in mind is most of these investors are not full-time SMB investors. There are actually very few of those. Most of these investors have a day job. Maybe they own a company in your industry. Maybe they work at Fang. Maybe they're, financial advisors or something like that. And they have a lot of fires that come up in their own lives. And if you're not making it really streamlined for them to kind of walk through your deal, walk through your diligence, walk through the terms, it's going to be hard to get them over the line to commit.
Yeah. So who helps fill out the? I used to do pitch decks, so that's telling a story in a short document. It's either a PDF document or it's a full thing pitch deck. Who helps them tell that story?
Yeah, so our internal team at Mainshares ends up digging in both on the pitch deck, but then also the diligence and kind of the full set of fundraising materials. So Judd, who's a member of our team, typically runs point on that. And, you don't have to over-engineer it is another thing I'd say. There's kind of a straightforward narrative that a lot of investors want to see. And it starts with who are you and why do you want to buy a business? And then it goes to what are your criteria? And then you want to naturally lead into this business met my criteria and my criteria make sense for my background. And at that point, there's kind of like business searcher fit of like, okay, it makes sense why this person wants to buy this business and why this business should be bought. Then you want to kind of drill down a level deeper on, okay, at what price does it make sense to buy the business? What are the risks of buying the business? How does it make sense to structure the deal? So at that point, you want to kind of step into, okay, what's the org chart of the business? Who's staying or who's leaving as a result of the transaction? What are the financials associated with the business? Is there customer concentration that needs to be guarded against? How are you going to get the seller to bear that risk? And then kind of once you've stepped through the operations, you have a deal structure. And once you have that deal structure, then kind of the last kind of pieces of the narrative are, okay, what's the upside downside? What happens if things don't go great? What happens if things go really well? And what's the base case that you're assuming? How are you planning to work with investors? So to get back to what we were chatting about earlier, are you going to be making quarterly distributions? Or are you going to be reinvesting and growing this thing aggressively? And based on what you say, you're going to have to back up that narrative. And then it kind of ends with, okay, this is the investment structure. This is the government's terms I'm going to use so that you know that I'm running the business well and you have insight into what's happening at the business. And then you can have an appendix if you want more supporting information. But I would say like very rarely do you have to start from scratch on what's the ideal capital raise narrative for buying a business. Most of the time it's pretty straightforward, and what we find is it's people either not putting the right information in or missing sections or not telling a cohesive narrative, and it feels like you have 20 different slides in a deck that have no relationship to one another. And really the goal is for that to be a cohesive narrative.
Yeah, I just think what will happen to a lot of guys is just there's some momentum and a down slide that just like, hey, I've got to raise 300,000. I don't really care how it's raised or what it looks like or how I got to pay back because I just got to close the deal. And they don't look at the consequences 2 to 3 years down the road.
Exactly. And that's where, to your question about timing, it gets really hard for us to do a good job and to have a great outcome for entrepreneurs if we're getting involved in the last 30 days that you're under contract. Because what's happening there is you're behind the 8 ball. You're going to blitz through all the materials. You're not going to have time for the investors to review all of them. And then meanwhile, you're going to start getting into negotiations with the seller and the broker because they're like, hey, man, what the heck? Where's the capital? You said you're going to be able to fund this transaction. I've heard crickets on the investor front, or I've heard crickets on the SBA front, because often what will happen is the SBA lenders will start underwriting. Once you sign your term sheet and you probably make a good faith deposit or like a packaging fee deposit, and then they'll stop at some point. And they'll say, hey, look, we don't want our credit committee to spend more time underwriting this until we have some amount of proof that you're going to be able to pull off the capital raise. So you need to start bringing us term sheets that, add up to maybe 25, 50, 60% of your total capital raise before we're going to go the last mile in terms of our underwriting. And so if you're at the 30-day mark, typically they have pencils down for the last week or two. It's going to be really hard to go from no term sheets to a bunch of term sheets in, a week and a half in order for them to be able to underwrite the loan and close the deal on time.
Yeah, unless you're really good at raising and before they write that
Yeah.
SBA number. Yeah.
Yeah.
So how many does
exactly.
that go to? So if I say I got a good deal, it's a fair price, SBA is committed, it's in underwriting, and I got a great pitch deck or whatever, and then how many people does that go out to right now before it goes to the broker dealer network?
Yeah, so it will only go to the broker-dealer network if you've signed an engagement letter with the broker-dealer. So we try to segregate those two entities pretty well. If you're sending it out on the Mainshares platform, the first question is, do you want it public or private? My recommendation for most entrepreneurs is start private. Start reaching out to investors that you've met or investors on the Mainshares platform before you make your capital raise public. That'll allow you to get a little momentum, but also get feedback from investors, because chances are you don't have everything buttoned up on day one, and there are things that are missing that investors are going to want to see, and you want to give yourself a little bit of a grace period to get some feedback from the initial investors before really kind of hitting gas. Once you do go live, I would say we probably have 90 to 100 accredited investors on the platform right now, and they're from a mix of different investor personas, if you will, or investor types, in terms of, are they looking for value appreciation, are they looking for cash flow distributions, what is their check size, are they more of a small check, a 25K check that's just going to help you fill out the round, or are they more of an anchor investor who's looking at 250K 500K checks, and then obviously what is their ideal involvement with the business. Some are looking to make few investments, so they want to be relatively concentrated, and they want to figure out how they can dig in. So for instance, like there's an investor who is deep in the IT services space. And so for IT services capital raises, what he wants to do is really help connect to other clients. Think about how you can streamline delivery. He's not going to be a fit if you're buying an HVAC business. He's not going to have any interest into that. That doesn't meet his investment criteria. And so, my recommendation is to be eyes wide open on what you want and what your investor composition should be. So for instance, typically what I see is maybe you have half of the round just be silent partners. So they're just looking to get, a return on their investment. They're not looking to be involved. And then have, the other half of the round or a quarter of the round be more strategic value add people who can really help you out. And a great example of that, Mainshares wasn't involved in this transaction, but Beacon is an entrepreneur raised capital from an investor buying it was a mix commercial and residential landscaping company. He wanted to grow the commercial landscaping accounts. He got an investor who was really plugged into the HOA and commercial kind of real estate world in the city that he bought it in. That investor was immediately able to go to some of the commercial properties that he owned and switch their landscaping contracts to the business he just invested in. So I think there can be like really cool win-win stories of when the investor can really unlock revenue growth or help you achieve your growth goals. And so as an entrepreneur, I'd want to kind of think about that when you're meeting with investors.
Yeah, I think I know what you're talking about with that guy.
Yeah.
So how do you make sure, if there's 100 investors on the platform and I got a great deal, that they see it, they know they see it? Because if I was going to do this by myself and I say, oh, I've got a big social network out there and I want to put my deal in front of them, I want to make sure that, if I send them a LinkedIn deal, hey, man, I got my deal. If you're interested in investing, let me know. Click right here. I got all the docs and presentation.
Totally. So as soon as you mark your capital raise as public, the investor network will be notified, and then they will start requesting access to your deal. So you'll have a portal on the Mainshares website where you can see all the investors, what their stage in the kind of the pipeline is. You can invite investors to check out your deal that aren't on Mainshares right now, as well as see all the active investors on Mainshares that have requested access. Once you grant access, they'll then be able to see the data room. They'll be able to look at all the materials that you've kind of assembled for your capital raise. And then at that point, oftentimes they'll reach out with a few questions. Once their questions are answered, pretty quickly, they'll either pass on the deal because it's not a good fit, or they'll go through and sign a commitment letter through the platform. The one caveat is, in order to do that, the investors need to go through a quick accreditation process, because all of the private placements that we're doing on the platform right now are 506C, and that means that it's only for accredited investors. And so there's a quick accreditation check. Once they're signed and committed, then you're able to start tracking, okay, I'm 10% of the way there, I'm 20% of the way there, I'm 40% of the way there. Once the round is then closed, you'll mark it off so additional investors aren't coming through, and you'll have your preliminary cap table. Our operations team will then help you go through that fund seasoning capital call workflow. Based on the SBA lender, they'll either want the investors to wire money to your operating account, so your new business's checking account, or they'll say, hey, send it directly to the bank escrow, and we'll keep the money there until the deal closes. And this ends up being kind of deal by deal, or rather bank by bank. And so we'll help do some of the legwork, because what a lot of people forget, they're like, oh, I'll raise capital by myself. My attorney will help me draft the docs. I'll reach out to some people, get the deal done. It ends up being a lot more work than they think. And it's at a time where they're getting completely overwhelmed with a transition plan, or the seller hasn't, cleared the liens on the vehicle so the transaction can't close, or they need to go get life insurance and get a physical. And so we're trying to help them really focus on like, okay, you focus on getting the deal to close and making sure that the transition is a success and that the transaction is a success. Let us work on some of the back office compliance and operational tasks to get the deal financed from the investor side.
Let me ask you about this, how you create FOMO with the investors, because you'll be able to see like, hey, this is my LOI is going to only last 90 days. I'm already 30 days down, still going through underwriting. And the investor, somebody took interest, but all these investors are different. So one of them could be a real estate agent, somebody could be an ex-Facebook engineer, and the other guy's just sold his company and sitting back and going, want to help other entrepreneurs. They're asking different types of questions.
Yeah.
How do you get them to get off their butt and go, hey, write a check?
Yeah. So I think there are a few kind of tactics here. And obviously this is something that a lot of first-time fundraisers kind of have to learn. But I would say on the one end, you want to make it feel like you're selecting the investors as much as they are selecting you. And you want to come across as picky on who you're working with and what your expectations of your investors are. People hate what they can't have, and they want to be thought of as meeting all the criteria. So that's thing number one. Be upfront on, this is my ideal investor. Ask questions about that. Ask about other investments they've made. Ask if you can get references to those investments. So there's some things you can do on that front. Make sure that it's not just you answering the questions. Make sure that you're also asking the questions, because not only does it kind of create a sense of selectiveness with your capital raise, you should probably also know the answers to that if you're going to get in bed with this investor crew for the next 5-7 years and whatnot. So I'd say that's number one. Number two is share updates of all of the work that you're doing behind the scenes. If you just, announce a capital raise to investors and then you're slowly getting commitment letters and no one hears from you, they're going to wonder, are they struggling to raise capital? Is this deal still on? Typically, while the capital raise is happening, you're going through due diligence. You may be doing a Q of E. You may be negotiating on the purchase agreement. Maybe you're negotiating on the consulting agreement with the seller. Keep people updated on those developments, because they feel like, okay, it's actually going to close at the target date. They're getting everything in place to pull this transaction off. I should make an answer pretty quickly. So I'd say that's kind of thing number two. And then thing number three is I would prioritize your investors. First, go after the more anchor checks. You obviously want your friendlies involved. So maybe you have a couple friends and family who are going to be putting in, 10, 15, 25K checks. Make sure you get those locked down. But then the next order of business is go find the 100, 200, 300, 400K checks, because they're going to help lead you along the capital raise, and you'll be able to kind of herd the rest of the cats relatively quickly. If you get it from the opposite angle and you have a bunch of 15, 20, 25K checks, A, you haven't made that much progress to the actual end goal of the capital raise, but B, savvy investors want to see that other people have diligenced the deal and have signed off with a decent sized check. If they see this just a bunch of small checks, they're worried, wait, have the other larger investors seen this in past? Are they not interested in this for some reason? And it gets back to your question, the FOMO. It's all, some amount of sheep psychology that happens with humans, and investors are no different. And they're going to get worried, wait, am I the only one jumping on this deal? So I'd say like those are kind of three ways that you can kind of drive on the FOMO front. But it ends up varying by both how the entrepreneur wants to run their capital raise, what the deal is, all of that sort of stuff.
How are you coaching these entrepreneurs that run an HVAC or buying an HVAC company that's never closed money before, asked for money from investors? How do you coach them on closing $50,000 or $200,000 from an investor? What do you?
Yeah, so I think you have to lean into your sweet spot. And a lot of investors actually love that searcher. They have high confidence that this person knows what they're signing up for and is going to be able to execute. And I think you want to lean into that. And so your goal shouldn't be, let me try to sound smart on the financial terms to this investor. Your goal should be, I know what a great HVAC business looks like. This is what it looks like. This is how I know that. And this business meets all those criteria. I also know exactly what needs to happen on a jobs per day basis, on field visits, whatever the terminology is of the industry that you're looking at. Show that you really understand the operational side and lean into that. Typically, the lenders will also help those types of operators and searchers a lot because they love them as well. Sure, there are a lot of guys out there who are high net worth. Maybe they're putting in $250K of their own money and they're looking for $100K of gap equity. There are a lot of investors who like those searchers. They're not going to struggle as much to get a deal done. And the question mark for those people are they actually going to be able to operate the business? And are they even going to like operating the business? Because, like it or not, corporate America is very different from running these blue collar businesses. And guess what happens when your crew lead gets a DUI? You're the one plumbing the toilets. And it's just sometimes it's a little bit of a culture shock for those searchers. So I would say, like, for the blue collar operator who really understands the trade, passionate about owning their own business, I wouldn't let the investors scare you away from buying an SMB and going through the search process. My advice would actually be, there are a lot of investors who prefer working with buyers like that, and to really lean in to the skills that you bring to the table.
Yeah. And how long does that process take to, you start having these conversations go? Are you letting them know that, hey, man, we got to close this in 90 days and say, are you in or are you out?
Yeah. And the entrepreneur is as well. The whole goal here is, like, let's standardize all the information so it's a lot easier to go through the diligence piece as an investor for these deals. And so it's very clear, like, okay, this is the target close date, or if the target close date needs to get updated for some reason, this is the updated date and this is why it was updated. And typically what you want is 2 weeks before then, you want pencils down. Because what they're going to have to do is fill out, I believe it's Form 1919 with the SBA lender, declare their background, how much ownership of the company they're going to have, also go through the fund seasoning. Typically, the SBA lenders want to see at least 1 month. Some of them want 2 months of the funds in the bank account to avoid, the retiring owner doing some sketchy equity roll on the side that kind of skims past their PG thresholds. And so we really want, 2 to 3 weeks before the actual close to have the round committed. The other piece for searchers to keep in mind is you're going to want to give people an update before you even call the capital, before the deal closes. Some people may be investing out of their 401k. They need to go through a process to access those funds. Other people may be needing to withdraw money from their money market account so they can get it in their bank account to fund the deal. And you need to give those people heads up as well. So there's, like, a lot of kind of nuts and bolts to get these transactions pulled off. And so, being very transparent up front about the timelines is crucial for getting these deals done.
So how many deals have successfully raised? I know you just started, so I'm not expecting
So
a huge resume, but
no. Yeah, so we got started over this past year, really got kind of the ball rolling this fall. So we're in the middle of our first full capital raise right now. We had another one for an auto shop in December, and then we're ramping up raises every month. So looks like we'll have another one in January. It looks like we have like 2 or 3 slated in February. And so the goal is, like, let's keep on growing our investor universe to match the requirements of the entrepreneurs that we're bringing on board. Make sure that we have the right types of investors for them, and keep on iterating on the experience for
and
the
how are you doing that, bringing investors to sign up? I mean, because if you look at it, goes, how many people want to invest in a auto shop? There's not a lot of people buying auto shops or understand the economics of an auto shop.
Yeah, there aren't. So a lot of what we're doing is kind of word of mouth. So SBA lenders are some of our best friends. They meet great buyers who need access to equity capital, and they also meet investors who are trying to reach out to understand, like, is it possible to passively own these businesses? What does it look like to kind of be an owner of one of these SMBs? So we get a lot of referrals from there. We also meet people, through Beacon who maybe they come in looking at a business, they realize they don't want to actively own a business and they're a better fit for passive investors. So right now we're not doing any, big advertising or sponsorships or anything like that. The focus really is on like quality and execution. And then once we really have things dialed in, then we'll scale up our marketing efforts. The other thing to keep in mind is, the average transaction period is around 12 months. And I would say around 50% of self-funded searchers transact. That's probably an optimistic stat, but that's the recent one that I've seen. And so a lot of, our focus is let's go meet great searchers out there, build a relationship with them, help them look at deals. If they need a pre-qual, they can request one from the broker dealer to make sure that, they can really transact, and then give them time to find the ideal deal for them. And then we will have earned the right to help them on their capital raise versus, aggressively spending advertising money, getting a bunch of people who are 30 days away from closing. You don't have the success stories that you're looking for because you're trying to kind of like cheat and skip ahead in the process. So our philosophy has been, focus on quality and doing it right and going a little bit slow so that we can go faster later.
Yeah. What happens if you start a campaign and it's kind of slow to get off? The HVAC guy doesn't have a lot of people to bring to it. And, the 100 people you have right now are tapped out, and say, we got to deploy the broker dealer network. And that supercharges your raise.
Yeah, it does. It does. So we try not to have, and we've yet to have a scenario where we've done it that way. Typically, the broker dealer will get involved on the front end, and it's really a question of how many investors do you already know and how much help do you need getting your raise off the ground. And if the
you
answer
have
is
zero, let's say you bring in zero.
If you have zero, you haven't fundraised before, and you're not very savvy on the financial side, my personal recommendation would be like, go work with some party who can really dig in with you and can aggressively, make sure that your deal happens and be focused on you. And for us, our broker dealer is an affiliate that can help in that regard. And the reason for that is that there's just so many like unknowns for the first time fundraiser that it's worth it to pay a little bit extra money to get it done right. And the thing about a broker dealer is they can have performance-based compensation fees where, they can get involved in soliciting, investors. They can get involved in really digging in on the due diligence side. So, the due diligence checklist for a broker dealer is very thorough because they have an obligation to make sure that investors are investing in, good investments. And so in that case, I would say get involved early, because what will happen is if you wait until, let's say that the capital raise isn't going really well, you're not getting the momentum you want, and you want a partner to dig in a bit deeper with you, the broker dealer probably has more due diligence requirements than you've done yourself on the seller. And so what you're going to have to do is double back to the seller for additional DD requests, which are going to kind of chip away at the finite goodwill in the tank, if you will, that a seller has. A lot of times you want to make sure that you hit the 80-20 of DD. The broker dealer, there is no such thing as an 80-20. You have to go all the way. So I'd say that's kind of a consideration with working with a broker dealer.
Yeah. So how does somebody go, okay, I know a guy is trying to raise, do they get compensated for referring them to you, or how would that work?
Yeah. So if you know any entrepreneurs looking to raise, so for our kind of like self-directed product, which has the flat fee pricing, and we're just giving you the tools and the resources to execute a raise, we can pay referral fees from that. On the broker dealer side, unfortunately, we can't unless you're also registered with a broker dealer. We can't, share the success-based fees there, but we can if it's someone who's, looking
unless
to
the
do a
referrer
self-directed
was on the
raise.
cap table from the origin.
Right.
Yeah.
Right.
Yeah. Interesting. William, that sounds like you're solving a problem with a lot of these guys. First of all, is a lot of these guys don't have a big proof of funds to get a look inside a deal, and you're offering that if you start early. And then you're going to help them raise the capital to make up the gap as long as they can get SBAs. Also, have you done anywhere, raises where it raises the majority of it to be able to purchase it from just debt or equity?
We haven't done any yet. That being said, one of the other things that we do at Mainshares is provide tools for managing your investors. So a big question that investors have is, are the books and records being kept appropriately, or is the new searcher doing the same song and dance that the seller did in terms of running personal expenses through it? They also want to know, okay, how much cash is on hand? Are there going to be distributions this quarter? And they just want a little bit of insight into the business so they don't have to bug the searcher themselves. Especially for the first-time buyer, that increases their kind of trust and confidence in a capital raise and an acquisition, so on and so forth. So we built some tools there. One of the recent clients has onboarded his investors to the platform to use our investment management tools, did execute an all equity raise that had more of kind of like the MOIC hurdles, which is a way of structuring the investment. And so I anticipate, we learned a lot by talking with him about how he approached that capital raise. And we're interested in doing that because one thing that we've seen is for a lot of searchers who may have a real estate portfolio on the side, they hate the SBA because the SBA is going to go around and attach liens to every single real estate project they have on the side, even if in their mind it has nothing to do with the business. And so a lot of those searchers are looking more at, okay, let's get a 20-30% seller note and let's do the rest with equity, either cash that they have on the sidelines or from investors. And so I think you'll see over the next handful of years more and more all equity deals getting done, especially as more of these investors kind of come down into the market.
I believe so, because I tell you, if people are moving up, I mean, my wife will divorce me if I sign another personal guarantee.
You're not the only one. I think I heard that
William,
earlier
that
this
was
morning.
Fantastic. I appreciate the intro to Mainshares, and I wish you the best of success.
Thanks, John. Thanks for having us on.
I hope this video has inspired you. If you need help buying your first $1 million business, make sure to visit me at dealflowsystem.net. If you like this video, make sure you subscribe down below. Comment on it, share it, tell everyone about it. And thanks for watching.